Welcome back, future retirees. This is Dr. Jeff Wilson coming to you from our fabulous Freetirement studio right here in sunny Southern California. So, continuing our discussion about asset classes, now that we've discussed qualified and non-qualified asset classes like stocks, bonds, mutual funds, and ETFs, it's important to briefly review other types of asset classes. Although it's not going to be a focus of the Academy, but when we're discussing your net worth and trying to create a financial strategy for retirement income, all of these asset classes are going to be important for us to review. So, beyond cash, stocks, and mutual funds in retirement and non-retirement accounts, we have personal property that's considered an asset. So this could be, vehicles, jewelry, collectibles, and business interests. Business interests could include intellectual property as well. Let's just say you have a patent or a proprietary formula in the business. All of these could be valued as having a dollar amount, a dollar value associated with each of them. Now, of course, we have real assets or real estate, like, rental properties, primary residences, and last but not least, insurance policies. Some types of insurance policies are considered asset classes. Others are standalone insurance policies. In this case, we're talking about whole life insurance, universal life insurance, variable universal life insurance, and index universal life insurance. All of these could be considered asset classes because of the cash value they have. Now, this is not all an exhaustive list of asset classes, because when we're talking about qualified accounts, it can encompass even more. So for non-qualified accounts, you can have structured notes, certificates of deposit, but typically speaking, any of those instruments will fit within one of the general categories for asset classes. So when we are creating any sort of a financial map or financial strategy, it's just important for us to have some way of measuring all of these assets. Okay, there are some uniform standards of what asset classes fall into, but at the end of the day, this is your plan. So we want to make sure we are accounting for every single asset class that you consider valuable and keeping a very accurate tally of all of your or our net worth, okay? Now, why is it so important for us to have an understanding of what these asset classes mean? I would say, first and foremost, when it comes to retirement, this concept of distribution planning keeps coming up. Most individuals have done a pretty good job up until this point of accumulating assets, right? Just investing in your retirement accounts, maybe purchasing real estate properties, purchasing stocks, or even mutual funds, okay? When it comes to retirement, now you need to start thinking about this distribution or decumulation phase of your financial strategy. And when we're talking about this, a few things really stand out. Making sure we don't run out of money and making sure we keep more of what we've earned and give less to the IRS. That's very important. So tax efficient distribution is the name of the game when it comes to retirement planning. As we diversify our net worth throughout these asset classes and when we're tailoring them, if we are noticing large imbalances, for example, if we're seeing a large amount of pre-tax qualified assets and not enough Roth, this could signal opportunities for things like Roth conversion. But at the end of the day, our goal is that in retirement, we want to have an efficient distribution strategy when it comes to our taxes. Now, let's go through two different examples of someone who uses this. Basically, one account at a time where they distribute most of their taxable accounts, then they distribute their traditional, and then their Roth. We've seen a lot of anecdotal examples of individuals giving and receiving advice saying, all right, leave your Roth account to the very end and take your taxable accounts first. Why? Their reasoning is that Roth accounts are most tax advantage. Taxable accounts are least tax advantage. So we should take the least tax advantage accounts first, right? That is not the complete story, however. We want to always pay attention to that year's tax bracket, right? Any sort of known information about the future tax rates is important. And we need to try to do a proportional distribution from our assets to make sure we're staying within certain tax brackets. Very important. Before we dive deep into the tax bracket management, which is such a critical part of your retirement distribution strategy, let's briefly review the terms marginal tax rate and effective tax rate. So, marginal tax rate is the percentage of tax applied to your next dollar of income. So in simple terms, it's what you pay on an additional dollar earned, okay? Now, the effective tax rate, on the other hand, okay, is the average rate you're gonna pay on your total income. So it considers all tax brackets and deductions, providing an overall percentage of your income that goes to taxes. While your marginal rate helps predict the tax on extra earnings, the effective rate reflects the overall impact of taxes on your income. Okay, so an example. Let's assume Jake and Susie have control over how much funds they withdraw from their taxable versus their non-taxable accounts, such as Roth. A dive into their tax bracket shows that Susie and Jack can keep a lot more of what they've saved for retirement as long as they're able to maintain a reasonable tax bracket during their distributions. So the standard deduction for a married couple filing jointly is $27,700 in 2023. So a married couple can earn up to that amount and owe no federal taxes. Now, based on the 2023 federal tax brackets, a married couple can earn an additional $22,000 beyond their standard deduction and remain in the 10% marginal tax rate. In other words, if a married couple earned $49,700 in 2023, they would only owe $2,200 in federal taxes, bringing their effective tax rate on the first $49,700 of income to a mere 4.4%. That's a great rate. Now, going down the tax brackets, there is a 12% bracket right below the 10% that would allow a married couple an additional $67,450 of income with only an additional $8,094 in federal taxes. So what does that mean? That means on the first $117,150, you're only going to pay approximately $10,000 in taxes, bringing your effective tax rate to a mere 8.8%. Now, it's the distributions beyond this point that should be taken with additional consideration of its tax impact, because we suddenly jump to a 22% tax rate. So every $5 that you distribute beyond this point, you're more than $1 to the IRS for that, right? So for every $5, it's going to be more than $1 to the IRS. So minimizing pre-tax distributions in these marginal rates will allow you to keep more of your hard-earned dollars. Now, we are not saying to limit your lifestyle to that income, especially if you have the means to spend more, right? The smart thing to do is to tap into your post-tax investments, such as your Roth, the Roth IRAs, for any distributions in these marginal rates. This will help you avoid severe tax consequences and will prevent your pre-tax accounts from premature depletion. So this allows us to essentially keep more of what we've earned and pay less to the IRS. The timing for which you collect your Social Security could be a critical step in managing your post-retirement tax bracket. In your workbook under Module 1.5, you're going to find a useful PDF that details how Social Security income is taxed. In short, Social Security is taxed based on how much other income you receive in the year. So if you plan on front-loading distributions from your pre-tax retirement accounts, it's best to consider deferring your Social Security, not only to manage your tax bracket, but also to hedge against longevity. Okay, let's go over exactly how this could pan out for a particular individual. So in this scenario where someone just takes the lump sum method of taking all their taxable distributions first, then their traditional, and then the Roth, they are not effectively spreading out their taxes throughout the years. And what ends up happening is during these years where they're taking traditional withdrawals, they experience the tax bump. Now, on the other hand, if they were able to take their taxable withdrawals and traditional withdrawals right up to the point where the combined total would push them into a higher tax brackets, you follow me on this? Then take any additional withdrawals from their Roth IRAs. This strategy will minimize the impact of taxes on their bottom line spending potential. Hope that makes sense. They're able to effectively spread their taxes throughout the years and take advantage of those low brackets that range from anywhere from 0 all the way to 12%. So in this particular example, if the person goes through this conventional wisdom or suggests spending taxable assets first, they will have about $200,000 in their taxable account. $200,000 in tax deferred, and let's just say $200,000 in tax exempt. Their overall estimated taxes for that would be $59,064. Now, for that same individual, if they were to take those distributions proportionally, they'd be looking at a 36% reduction in taxes, or $37,777 in total taxes paid. So when it comes to a distribution strategy, it's not just a one-size-fits-all. Let's take the taxable accounts first and defer Roth to later. No. Every single year that you're taking your distributions, you got to pay close attention to what taxable income you're earning from guaranteed sources, such as Social Security or pensions or sources that are not really in your control. And then consider how much you're taking from these other accounts to keep yourself within those tax brackets. That's the essence of the efficient tax department. Now that we've discussed various asset classes, their taxation, and the impact of efficient tax distribution, let's complete the other half of our balance sheet, which is liabilities. Now, liabilities are essentially any sort of future outward flow of cash that's going to be required from you. Anything that you owe to someone else, right? So liabilities could be current or future obligations. They could be tied to a particular asset, or they could be unsecured, such as credit card debt. Not all liabilities are made the same. For example, a high-interest credit card, a personal loan rate, is not the same as a 2.5% mortgage that you have on your house, which is tax deductible. So whenever we're listing our liabilities, it's important to understand their duration and their interest rate. How long do we have to pay this debt is a key question. What is the interest rate that we're being charged? And of course, what is the monthly minimum payment that we need to pay to stay current with that debt responsibility? So when listing our liabilities, we should include such things as mortgages, student loans, and personal lines of credit. This could also be your tax liability associated with a particular account. So if you have pre-tax accounts, how much you would expect to pay in taxes would actually be considered a tax liability. If you owe taxes to the IRS, that would also be considered a tax liability from previous years. So when we're writing down all the assets, we also write down the tax liabilities, and then we'll be able to get to a number which is called the net worth. This is basically your assets minus your liabilities. Now, after figuring out your assets and liabilities, the next important category to start writing down is called the income worksheet, or your cash flow statement. So this is going to be essentially listing all the sources of income that you receive. Now, sources of income could be normal income, from your present career or jobs, your W-2 or 1099 income. But after you enter the retirement phase, it's typically going to be some combination of Social Security, pension income, and distributions from your retirement accounts. It could also include dividends from your stocks. It could be shares or dividends or interest received from a business ownership that you have or an interest in a particular business that you have. So all of this should be listed on your income worksheet. And on the same worksheet, we're going to note expenses as well. So we will categorize expenses between discretionary and non-discretionary expenses. Now, non-discretionary expenses are going to be all the fixed, non-negotiable expenses that you have each month. This will be things like utilities, your healthcare costs, your food and transportation costs. And then discretionary expenses will be all the other stuff that you'd like to do for fun in addition to those. Having a really strong understanding of what your income is coming in from, whether they're guaranteed sources or your non-discretionary expenses, is really going to inform you about how much risk you can be taking on your investment assets. Because we could be a little more, we can allow for a little bit more risk to be taken on investments if our non-discretionary expenses are being met from a guaranteed source of income. So let me give you an example of that. Let's say you have $5,000 a month in mortgage, utility payments, along with the cost of food and health insurance. I know that doesn't seem like very much, but let's use $5,000 as a tool. So your minimum spend or fixed expenditures each month is $5,000. If you have $6,000 coming in from guaranteed sources and you are not planning on buying anything new, you can allow yourself to take a little bit more risk on your investment assets and try to get a better return in the long term. However, if you have all of your investment holdings providing income on a non-guaranteed basis, and each month you have that same fixed expense of $5,000 or even $6,000 or $7,000, you will have to lower the risk on your portfolio to ensure that you're not taking too large of a distribution in a down market. Large distributions in a down market could deplete your account faster than expected. So we're going to talk about this in more detail in an upcoming video on the sequence of return risks. But at the end of the day, you're going to need to ensure that your fixed expenses are secured from a source of income that's also secured. So safe and reliable sources of income like Social Security or pensions are a great way to do this. Rental income, although not really 100% secure, could also kind of fit in there as a type of an income that you can somewhat count on. It is distributions from retirement accounts that should be really left for non-discretionary expenses. So, in this situation, it makes sense for individuals to consider building additional guaranteed streams of income in their retirement if they're noticing that their monthly expenses are being paid from volatile portfolio positions and is keeping them up at night, right? Think about it this way. Your mortgage company doesn't really care if your 401k or your 403b is down 20% this year. They're still going to want their payment, right? Your health insurance company is not going to lower your insurance premium just because the markets are down. So if you don't want to take distributions during down markets and be a victim to the sequence of return risk, you should diversify your holdings, and not just in tax classification, such as pre-tax or after-tax IRAs. No, we're recommending that you should further diversify them by their risk tolerance and make sure that guaranteed sources of income are generating enough revenue for you to pay your non-discretionary expenses. Well, congratulations. You have completed Module 1 in the Freetirement Academy. By now, you should have a far greater understanding of your own retirement starting point and trajectory. You have mapped out your assets and your liabilities. You know more about asset classes, and you're developing a balanced portfolio. You've learned about using tax-smart tax strategies to keep more of your hard-earned money. And in this video, you've gone deeper in better understanding your asset map so that you can more effectively plan your distribution phase in such a way as to minimize your taxable footprint in retirement. Cheers to your incredible journey ahead. I can't wait to see you in Module 2, where we're going to look at some really interesting tactics and strategies to offset potential dangers lurking around our retirement corner. You will find Module 2 to be extremely helpful and practical for planning and looking at market risks and volatility, sequence of return risks, asymmetry of returns, and the impact of using target date funds. And we're going to introduce you to structured products as well. I can't wait. So, this is Dr. Jeff Wilson, hoping you are thriving in life, living well in every moment, and sharing your prosperity with those you love. Cheers to your incredible journey ahead.